And this evening we are looking at absorption and marginal costing. Absorption and marginal costing is a topic we're looking at right about now. Now, as we look at absorption costing to start with, this is the full product cost, um, where we are looking at the total product cost in terms of both the variable cost per unit of a product and then the fixed cost per unit of a product. So this chapter defines marginal costing, absorption costing system, and then we are looking at the full costing, which is called absorption costing, and also the marginal costing. All right, so these are the two costings that we're looking at this evening. Now, only the aspect of contribution comes in when you're looking at the costing aspect, which is called marginal costing, where we are looking at the contribution margins for the marginal costing. Now, we will also have to build up a little bit, where we also have to look at the profit statements under absorption and marginal costing. And okay, we also look at the advantages and disadvantages of marginal costing, and of course, the advantages and disadvantages of absorption costing. All right, this is the one thing that we are going to look at this evening. Okay, so learning outcomes for this one, we define the marginal costing, what is it about? We'll also look at the definitions of absorption costing and what are the contribution concepts in this marginal costing. And now we get into the profit statements for absorption and marginal costing principles. And now we look at the reconciliation profits protected by the absorption and the marginal costing principles. All right, then we'll look at what is marginal costing. This is the cost. Okay, this is part of the cost of one unit of a product or service, which would be avoided if the units were not produced. All right, so marginal costing is talking about a costing aspect that the firm can actually um, avoid if there is no production. All right, and then we're talking about this costing where if you don't, there's some costs that we can actually avoid. All right, like marginal costing deals with variable cost, variable production costs. So marginal costing is a term that is used when you're talking about the variable production cost. All right, where we're looking at how many units we've produced and at what cost. Then this is a cost we can actually avoid. All right, on the marginal costing. And then the types of marginal costing that we look at here, what is involved in marginal costing. Okay, marginal production cost per unit of usually consists of the direct materials, you have the direct labor, the variable production overheads. All right, this is about what marginal costing is all about. So we only need to handle the variable cost of production per unit, like the labor, material cost, and then variable production overhead cost. That's a term marginal. Now, marginal costing is a accounting system in which variable costs are charged to the cost of units and fixed costs of the period is written off in full against the total contribution. All right. So in the marginal costing, the fixed costs are written off in full against the total contribution for us to get um, the net profit. All right. So for us to get a net profit, we actually write off the fixed cost written off in full against the total contribution. All right. So we get into the principles of marginal costing. Okay. Marginal is anything to do with variable and fixed costs are the same for any volume of activity. So we assume that the fixed costs are the same for any volume of activity because the fixed cost does not vary with production. Now, by producing and selling an extra unit or service, only the variable cost increases. And by producing and selling the additional units, the total profit increased by the amount of contribution from that unit. Okay, then there we get into absorption costing, which is also called the full costing. So under absorption costing, we are simply saying that both the variable and the fixed costs are absorbed into the cost units. The fundamental difference between the marginal and absorption costing is one of timing. In marginal costing, fixed costs are written off in the period incurred. In absorption costing, fixed production costs are absorbed into units and written off in the period in which they are sold. All right. So are we getting down to differences between marginal and absorption costing? We have their information there where we're talking about closing stocks are valued at marginal production cost. All right. And then closing stock are valued at full production cost. That's the difference, major one, because absorption costing is the full product cost. Closing stocks are valued at marginal production cost. Closing stocks are valued at full production cost. That is, this one is valued at variable costs for marginal. Then fixed costs are treated as period costs, are written off in full to profit and loss account. Absorption costing, fixed costs are treated as part of product costs. So now we get into an example here. We're looking at the product cost under marginal and absorption costing. Example, a company produces a single product and has a following budget. So selling price is a 10,000 kwacha. Direct materials, which is the 3,000. Direct wages is a 2,000. Variable overheads is a 1,000. So meaning the total variable cost for these units, you only add the direct materials, the direct wages, and then variable overheads. So we are getting to a 3,000, 2,000, and 1,000. These are the variable overheads. And we are getting the variable cost per unit for this kind of company. The total variable cost in this case, we are saying it is actually 6,000. That is the, the total variable cost per unit of this product. All right. So the total variable cost per unit is actually um, 6,000. That is the total variable cost per unit of this product. Now, the fixed production overhead. Yes, is there a question?
Yes. Could you kindly explain again what the variable costs are?
All right, then. So when you talk about the variable costs, these are costs that vary with production. All right. An example, you talk about Uh, the major difference, first of all, before I get into the details of variable cost, we talk about the fixed cost. Fixed cost is whereby even if you are not producing anything in that company, but you have to pay rent. Rent will be a fixed cost because whether you are not producing anything, uh, you still have to pay rent. That's a fixed cost. But the variable cost, you as you produce a crate of soft drinks, all right? If the total cost involved is 50 kwacha for you to produce a crate of soft drinks like Fanta, if it's 50 kwacha, and then you have produced 5,000 crates, okay? So the variable cost will vary according to how many crates you have produced and at what cost and at what amount, what cost, all right? So meaning if 50 kwacha is the cost per crate and then you have produced 5,000 crates, then you can find the total variable cost actually involved in producing those 5,000 crates. All right. So it will vary with how many units, how many crates, how many bottles, how many crates you are producing. All right. That's the variable cost. But fixed cost does not vary. All right. So like in this case, the total variable cost in this case here, we are saying a single product, one product. We have a 3,000 kwacha there for a product, then on materials, and then the labor in producing those units, okay, we're producing a unit, which means one unit, a single product, it's a unit, all right? So we're getting labor is 2,000. Then variable overheads is 1,000. So the total variable cost here involved in producing, on production, is actually 6,000, all right? So this is what it means by a variable cost. Now, fixed production overhead is 10 million per month. So per month, we have a fixed overhead of 10 million per month. And then production volume is 5,000 per month. So meaning you can divide here to find what is the production, the fixed production cost per unit. All right. So you can find the fixed production cost per unit of this product. So you simply have to make to divide and get the appropriate answer that we need. All right. So this is how you get the fixed production over 10 million per month, and then production volume is 5,000. So you need to divide and get the fixed cost per unit. All right. So now, under marginal costing, we only account for direct materials, direct wages, and all what is variable is under marginal costing. And then under absorption costing is a full product cost. All right. So this is where we now look at the direct material, direct labor, or direct wages, direct variable overheads, and the fixed overhead. So it will be, if you divide the 10 million, dividing by 5,000 units, so 10 million divided by 5,000 units, all right? So you're getting the 2,000. So meaning 2,000 will be the fixed production cost per unit, and then plus the total variable costs per unit, then you're going to have the product cost per unit, the total product cost per unit will be 3,000, 2,000, 1,000, and the 2,000 for from the other fixed one, which will give us 8,000. So meaning this is why we have here what full product absorption cost per unit. Direct materials is 3,000. That of the wages, we are getting a 2,000. The variable overhead is 1,000, and the absorbed fixed overhead is 10 million divided by 5,000 units. We are getting a 2,000 kwacha, which is the fixed overhead cost per unit. This is what it actually means. So the full cost of this product per unit will be that of 3,000, 2,000, 1,000, 2,000, we see getting out to 8,000. This is the full production cost per unit. All right. Now, for the marginal costing, we only concentrate on the variable costs, direct materials of 3,000, direct wages of 2,000, variable overheads of 1,000, marginal cost per unit, which is 6,000. So this is what we are. That is what we have. So from here, we actually are able to, we can find the profit per unit for marginal costing. If we can go back to selling price per unit, yeah, which is a 10,000, then minus each of those ones. So subtract for marginal costing, subtract the 10,000 minus the cost for marginal costing is 6,000 to find the contribution for marginal costing, which will be about 4,000. Then getting down to absorption costing, it will be 10,000 minus the 8,000 to be about 2,000. So that's what we have. Now, we have to get into the format for marginal costing. So we have to look at um, the the one that uses the full product cost, and then the other one does not use the full product cost. All right. So getting down to an example here. Okay, digging down to an example. Of course, before example, we have the format for marginal costing, which is for variable costs, and then absorption costing, it is for the full product cost. All right. So we have going to to use the full product cost. But now, getting down to an example here, where we are saying comprehensive illustrative equation on marginal and absorption costing. X Limited commenced business on 1st January, making one product only with the following costs. So we have the direct labor, 5, direct material is 8, that's per unit. Variable production overhead is 2 per unit. Fixed production overhead is 5 per unit. All right. These production overheads. So meaning this 20 will apply for the full product cost as we getting down to the full of the question. But in the case of marginal costing, we only concentrate on direct labor 5. We add the 5 plus an 8, then plus a 2 for variable production cost, because marginal costing only deals with the variable cost. Then we'll get into the calculations of marginal costing. Okay. Now, the fixed production overhead figure has been calculated on the basis of a budgeted normal output of 36,000 units per annum. So per year, we have 36,000 units, which was budgeted. All right. So meaning that if we are to find for a month, we should divide, they say 36,000 units, which was budgeted for the year, divided by 12. We are getting 3,000 units per month. That will be have been budgeted per month, because the 36,000 units would have been for a year. All right. Now, you are to assume that there is no expenditure or efficiency variance, and that all budgeted expenditure is incurred evenly over the year. Selling, distribution, and administrative expenses are fixed 120 million for the entire year, meaning that we can divide the 120 million for the year, because they're saying that you have to assume that there is no expenditure or efficiency variance, and that all budgeted expenditure is incurred evenly over the year. All right. So meaning the 120 million we divide by 12 months to find it's a 10 million, which is the budgeted selling, distribution, and the administrative expense that would have been there for a month. All right. Same as the budgeted units was 36,000 units per annum, dividing by 12. We can find how many units are supposed to be budgeted per month. Because per annum was 36,000 units, so divided by 12, they're getting 3,000 units per month. Budgeted selling, distribution, and admin expense is 120 million, dividing by 12, where we are getting the 10 million. Then from here, we are saying selling, distribution, and admin expenses, the variable are 15% of sales. All right, so 15% of sales are the variable. Then we have the selling price per unit is 35,000, and then the number of units produced and sold, where March and April, we have the units production is 2,000, April 3,200, and then sales, we only sold 1,500 for March, and then April, we only sold the 3,000. And then our budgeted plan, we know that we have a 3,000 units, because the budget normal is 36,000 units divided by 12. So we are saying 3,000 units are the budgeted units per month. So we can now know that in March, since we produced 2,000 units, there was an absorption of 1,000 units, because our budgeted was 36,000 units divided by 12, which is a 3,000 units. And in March, we only produced a 2,000 units. So we produced less than budgeted, meaning that budgeted was 3,000. We produced a 2,000. There was an absorption of 1,000. In April, there was over absorption of 200 units. All right. So that's what it means here. And then for March, we only sold 1,500. We produced a 2,000, meaning that 500 was a closing stock after we produced a 2,000. Then we sold 1,500. Then it means that our closing stock was 500 units, which would have been an opening stock for April plus our production of 3,200, meaning that the closing stock for April would have been 700, because we opened with 500, which was the closing stock for March, opening stock for April, plus production of 3,200, minus the sales of 3,000, which will give us the closing value of 700. Now, prepare a profit statement for each of the months for March and April using marginal costing and absorption costing. Now, we are getting down to the solution. We are saying production overhead is 36,000 units times 5. Why 5? 5 is the fixed cost, which is here in this one. Fixed production overhead is 5. We produce 36,000 units. So meaning we multiply by 5, we're getting 180,000 the kwacha for the overhead. Now 180,000 kwacha for the overhead divided by 12, we are getting 15,000, because that was for the year. The 180,000 was for the year, because the budgeted units for the year we had 36,000. Okay, then which is what again is, so meaning per month is 15,000. Selling and administrating, it was 120 million. dividing by 12 is a 10 million or 10,000. All right. So getting down to marginal costing statement, we are going to say sales is 35. Okay, so this is for March and April. March and April for the so for the March, we're getting the sales was 35 quarter multiplied by 1,500. Or it was 35,000. They rebased here. They rebased. So 35 multiplied by 1,500. Okay, then that's what we have. So we're getting 52,500 for March. Then our opening stock was variable production was 15 multiplied by 2,000. Opening stock was zero in this case. We did not open with any for now. For March, opening stock was zero. So that's why it's zero here. Variable production of cost, it is 15 multiplied by 2,000 because we produced the 2,000 units. So production is 15 because we're adding only the direct for marginal 5 plus 8, 13 plus 2, 15. That's where the 15 is coming from. We are ignoring the fixed cost because marginal costing is not a full product cost. So we are getting to 15 times 2,000. All right. Then closing stock is 15 times 500. 500 is as a result. We produced the 2,000. We sold 1,500. That's the 500 where it's coming from, which is 75. We are closing it. Then we are going to add variable production cost of sales, variable production cost of sales, which is 15% of 52,500. Okay, variable selling, which is 15 or 52,500, because the question here says is 15% of the sales variable value, 15% of sales. So this is why we have 15% of the sales of 52,500, which is 78.75. Then total variable cost, we have 33.75. We subtract this figure, the total variable cost, from the sales figure of 52,500. We are getting the total contribution of 22,125. That's the total contribution. Less the fixed costs. Fixed costs we have for production 15,000. All right, which is here per month 15,000. Okay, which is 185 by 12, which is 15,000, which is here less this one. Less selling and administrative. It was 120 budgeted for the year. Divide by 12 is 10,000, which is this 10,000. Then we have from the 22 125 subtract these costs. We have the profit or loss of 28.75. That's for marginal costing. All right, then we get into marginal costing for April. We're going to have 35 multiplied by 3,000 for the sales because we sold the 3,000 units in April. So it is actually 35 by 3,000, which is 105,000. Then opening stock, all right, opening stock was actually 500 multiplied by 5, that's 15 multiplied by 500 because there was an opening stock of 500 for April, which was a closing stock for March. So it's giving us 7,500. Then variable production cost, it will be 15 multiplied by, we produce the 3,200 units. So we are getting 48,000. Then closing stock was 15 by 700. 700 was as a result of closing stock of 500 here plus production of 3,200 minus a 3,000. So we are getting closing stock of 10,500. We are lessing it. Then add variable selling expense, 15% of sales value, sales revenue of 105. You're getting the 15,750. And then the total variable cost, we add these ones, subtract that one, you're getting the 6750. There's another format which Mr. Njov would send, is going to send, which may be a bit simplified after this lesson. You may send to you on the group so that people can see, or now this format is not that clear. And then contribution is 44,250, which is the sales minus variable cost of sales, 44,250. Then less the fixed costs, the same fixed cost, which is 15,000 for production, and then 10,000 for selling and administrative. We are getting the 19,250. All right. So that is the profit and loss for marginal costing. Then absorption costing, getting quickly into absorption costing. This is the full product cost. So the sales will be the same for March. It will be 35 multiplied by 1,552,500. Opening stock weight, all right, is zero. Production cost, we produced it at full cost of 20 kwacha. Then multiplied by how many units we produced was 2,000. So we are getting to 20 times 2,000, which is 40,000. Closing stock was the less closing stock was 20 times 500, which is the 10,000. So we are getting the difference between these two is the cost of sales, which is 30,000. Then 52,500 minus 30,000, we have the gross profit of 22,500. All right. Then we're supposed to add under or over absorption. So if it is under absorption, you subtract. Over absorption, you add. So under absorption, so this one was under absorption because budgeted units to be produced was 36,000 units divided by 12, which was 3,000. But for March, we only produced at 2,000. So meaning there was an absorption of 1,000. So that 1,000 multiplied by the fixed production cost of 5, that's where the 5,000 is coming from here on under absorption, which is minus. The budgeted units was 3,000. Then we only produced a 2,000. So there was an absorption of 1,000. And then we subtract here. Then we said also subtract the variable selling expense. Variable selling expense, it is 15% of the sales figure for March, which is 15% of 52,500, which is giving us 7,875. And then fixed selling and administrative cost of 10,000. So subtracting these ones from the 22,500 from the gross profit, we have a profit or loss, which is the 375 negative. All right. So this is it on the absorption costing, excuse me, for the month of March. Okay. So now getting down to absorption costing for the month of April, we are going to say in April, as we go back, we sold 3,000 units and we produced at 3,200, meaning that for this one, there was over absorption of 200, not between these two, because the budgeted units was 36,000 units divided by 12, which was a 3,000 units. And we only, we produced the actual production was 3,200. So there was over absorption of 200. So getting down here for absorption costing, we are going to say sales is 35 multiplied by 3,000 because we sold the 3,000 units in April. So meaning we have 105,000. Then opening stock was 500 units multiplied by 20. So multiplied by the 20 is the total fixed cost. Total fixed cost, which is the 20 there. So that's where the figure for 10,000 is coming from. Then there was a production of 20 times 3,200. 20 is the full product cost in terms of total variable cost and total fixed cost. All right, then we are getting 64,000. Then less closing stock of 700 units because we only sold the 3,000. When we opened with a 500, we produced a 3,200. So closing stock was 20 by 700 is 14,000. And the cost of sales is 60,000 in this case for April. Then gross profit, we are getting 105,000 minus 60,000, which is giving us 45,000. Now we produced a 3,200 units, and our normal production would have been a 3,000. So there was over absorption of 200 units, which we should multiply by the fixed cost per unit of 5. That's where we should add over absorption of 1,000, which is here, which is over absorption 1,000. Then less variable selling expense. Variable selling expense is actually 15% of 105,000. It's actually giving us 15,750. That is 15% of 105,000, 15,750. And then less the fixed and selling administrative cost of 10,000, which is giving us the profit or loss positive of 20 to 50. So this absorption costing looks at the full product cost in terms of the variable costs, in terms of fixed costs, the total product cost, both fixed and variable. That's why we have the differences in terms of the way they're computed between the marginal costing and the absorption costing. And if we can look at the calculations here, we can see that under marginal costing, we have the term contribution, where we're looking at sales minus variable cost of sales. We have the term contribution. That's one major aspect of the difference between marginal and absorption costing. Then in absorption costing, we have the term gross profit, which is not found in the marginal costing. So marginal costing, the gross profit term is not there. So this is the major reason why we have these two computations or the statement of profit. So from the question required, where we're supposed to look at the profit statement for each of the months for April and May using absorption and marginal costing, these answers here, they are correct as I've gone through. The most important thing to understand here is which one uses the full product cost and which one uses the variable cost when computing the profit levels for each month. So this is what we have looked at today. For any more, anything else, we will get to get into details of another example as we link up for the other session. Uh, According to Mr. Njovu, when he's going to advise, then I'll run through another example to do with the absorption and marginal costing. For now, we can end here.